So, good morning. It's 11 o'clock now, so I'll get started. We've got a relatively short session today, so we're going to be talking 20 to 30 minutes about the tax changes coming in the new year. And those things I think that you should really be aware of. So if you've got a cup of tea, kick back, enjoy the session. It will be recorded, so you will get the recording sent out to you afterwards. I'm really excited to be here today and to welcome you as part of the eBay Elevate programme. This is a brand new webinar series that they're hosting. It's brought to you from eBay and Small Business Britain. And I just want to be really clear from here that everything I'm stating today is from me, is my information, my advice, suggestions, and they are my own views. So from a legal point of view, it doesn't reflect the views or positions of eBay or Small Business Britain. Who am I? So my name is Faye Watts, and I'm the tax partner at Fuse Accountants LLP. We're a firm of accountants in London. I'm the tax partner there, so it's my role to oversee all the tax planning, all the structural planning, look at everything that's coming up new with the legislation. And of course, we've had quite a few changes in the last 6 months in tax. We've had a lot of seesawing back and forth with a few things as well. So I'm not really going to talk about those things that have and haven't changed and reverted back, but I'm going to talk about the things that have changed and that are really important as a business owner for you today. I'm also going to tell you I'm a money coach, and I think the one thing that people sort of put off is their tax return and put off knowing about their tax, because it can be daunting, and also no one wants to get hit with a tax bill. And when you're self-employed running your own business, you've got that tax bill once or twice a year. And do you always put your money aside for your tax bill? Not everybody does, and of course it's really good practice to do so, but I'm not going to lecture you about that. So hopefully the information I've given you today would just allow you to make some informed choices in your business, to understand that tax is like any other business cost. It's an expense, it's a cost to you, it's going to affect your pocket. So the money that goes out in your tax bill is important when you're planning your cash flow, when you're replenishing stock, whatever you're doing, whether it's a service or goods business. Understanding that tax is money out is going to really help you. So the rates and the things that are coming up are going to be important today. So let's get cracking. Let me just pull you onto my next slide. Feel free to put any questions into the Q&A section. I will be keeping an eye on that, but of course we've got limited time. So, but I'll do my best to keep an eye on that as we go. So what we're going to cover in this session. So primarily the key things we're talking about are the tax changes ahead. So hopefully you'll know, if not you don't, but our tax year in the UK runs up to the 5th of April each year. So when I'm talking about the tax year, we're talking about the 5th of April, but we're also talking about some changes in this current tax year that are up to the 5th of April, but I'll be talking about the things that are coming from the 6th of April. If we're talking about corporate changes, I'll be talking about from the 1st of April, just so we're clear. So HMRC defined the 6th as being a UK for individuals, and the 1st of April is when changes kick in for companies. I'm also going to run you through making tax digital. There's been loads of conversation about this, loads of information in the press, and loads of scaremongering. And I'm just going to give you some really simple key information that you can take away and plan ahead. Somebody has just said they can't hear. Does anybody else have a problem with hearing me? I just want to make sure it may be your setting rather than mine. But please do give me a thumbs up if you can. Bear with me 1 second. I'm getting some thumbs up, so I'm afraid, Zoe, that might just be you. But hopefully the tech team behind can help you with that. And then I'm going to talk to you about why it matters and why these changes make a difference. Because what advice you were given maybe 5 years ago or 10 years ago, or even the last 3 years, may not be relevant right now. And these changes allow you to make some informed decisions about what's good for you. As I said, what was once upon a time relevant just may not be relevant right now. And I'm going to run into a Q&A, and hopefully we have time, but as I said, keep those questions coming. Let's just kick off with these 7 key tax changes that I think are affecting almost everybody, certainly those in business. The first one, the tax-free personal allowance, which was not so long ago, 12,500, went up by £70 a few years back, but it's staying put. And that's, if we think about inflation and where things are going and everything's costing more, this personal allowance is staying at 12,570. So what does that mean? That is the amount of income that anybody can earn, depending on thresholds, before they pay income tax. So that's what's called our personal allowance. And I'm talking right now about UK residents as well. I'm talking about UK businesses and individuals. So the tax-free personal allowance is for individuals. And the higher rate threshold, where you go into that higher rate of tax, is staying at 50,270. So what we're not seeing is any movement on that until 2028. Likewise, national insurance thresholds are remaining until 2028. So if you're planning, in previous years, the threshold used to go up, the allowance would go up a small amount each year. It's not until 2028. Now, of course, we could have a change of government. We could have a U-turn again. We could see changes, but this has been confirmed. This is in writing. Let's see what happens at the budget on the 15th of March in any event. But it does mean that more and more people now, as people rise in incomes, people are requesting pay rises, as people charging more because of inflation, that more people are going to be taxed and paying at the higher rates. So really crucial. So know those rates. And when I talk about the higher rate threshold, that's the rate at which 40% is. So I'm going to run you through those percentages and rates a little bit later. But this is just to give you a sense check. Feel free to photograph any of the slides as I go, but you're going to get the slides at the end. Okay, the second change, and this is quite big for anyone who's a higher earner, is the additional rate threshold. So we have a basic rate threshold, we have a high rate threshold, and then we have an additional rate threshold. The basic rate, excluding dividends and other unearned income, is 20%. Then we go to the higher rate is 40%, and then we go to this additional rate is 45%. That's our effective. That's our top rate of tax. Now, I will just throw in that our effective top rate of tax is actually 60% right now. I'll explain why later. But 45% is the actual tax rate, our highest tax rate. What's happening from the 6th of April 23 is the threshold that you would pay additional rate tax at 45% was 150. From the 6th of April 2023, that's coming down to 125,140. Now you might think that's a really random sum. It isn't. It's double the 12,570 that I just shared in the personal allowance in the last screen. And the reason that they've kept that, which I think is really harsh, as I said, this is my opinion, I'm feeling it's harsh, is that for every £2 of income you earn over 100,000, we're talking about profit here, or income from any source, you lose £1 of your tax-free personal allowance. So that little bit between 100,000 and 125,140, you effectively pay tax at 60%. So although I can't hear you, I'm hearing lots of ouches and lots of cringes. That's harsh. The fact that they're then bringing that threshold down to 45%, down to the 125, means we need to do some planning, or you need to do some planning if you are nearing that threshold employed. Yeah, I'm getting some shocked faces coming up through the chat. So yes, it means that anyone earning over 150 grand is now going to pay an extra 1,243 quid in tax compared to previous year. So you can see it starts adding up, and there's lots of other things that I'm not talking about, but this does have an impact on other things. I'm not going to talk through all the planning, but something that should be on your radar just is pensions, really important. Now, if you are a company, or if you're earning dividends from, it could be, I don't know, BT, whoever, the blue chip company, you're currently got a dividend allowance of £2,000, and that has been for a couple of years. That's coming down from April 2023 to 1,000. So that 2,000 was the tax-free, exempt, 0% actually amount. It's coming down to 1,000 quid, and then it's coming down further to £500 from April 24. What does that mean? It means if you are a company, a limited company, and that's how you trade, so how does it affect you? You're used to probably paying that first £2,000 of dividends yourself tax-free before you then start paying dividend taxes. It's reducing. So again, there's a little bit of squeeze. You're paying a little bit more tax overall. I will caveat the lower rate of dividend tax is 8.75%. So it's 8.75% on that 1,000 quid. Could be more if you're a higher rate. It adds up, it's all real money, and it's all a cost to your business. So it is going to impact shareholders of companies of all sizes, including that portfolio you might have with an online provider, shares you might have in a publicly listed company, as well as your own. The fourth big thing is the capital gains tax annual exemption. So a lot of people have relied on this when they're selling personal assets. If you're selling personal goods, so let's say you're selling shares, you're selling property, that's the second property, that would be covered under assets. So it'd be covered by capital gains tax, not income tax when you sell. And this annual exemption of 12,300 is very different from the 12,570, which is your personal allowance for income tax. So this CGT rate, so if you're selling a pot of shares, cryptocurrency, personal goods as well, although there's different rules for chattels and personal goods, so don't get caught up on that. But you might be selling a part of your business, you might be exiting your business and selling out. And this threshold is coming down from 12,300 to 6,000 from April 2023, and lowering again to 3,000 from April 2024. Again, another little squeeze. My opinion here, this is really going to affect I would say the older generation who have built a portfolio of shares, perhaps that's become their retirement pot. And what they'll do is they'll have the income from that portfolio, but they might draw down on that portfolio each year of some gains, sell some stock to contribute to their income. It's going to cost them more, it's going to cost you more as well if that impacts you. It's also worth noting that the capital gains tax rates of tax are lower than income tax. It's 20% high rate for shares, it's 28% on property. And then the lower rates, that's 10 and 18%. The government have been talking for many, many years about changing CGT rates. And it's been very speculative as to whether they're going to do it. Who knows what will happen on the 15th of March at our next budget. But it does mean that if you are selling shares or assets that you might be using the cash flow for your business, just be mindful of this. So maybe selling stock now pre-5th of April, providing you haven't lost loads of money, of course, would be a good planning tip. No change to the £85,000 VAT registration threshold. This has been around, another threshold that's been here for a while. It was 83, then it went to, I can't remember actually if it went to 84, but it hasn't moved up very much for a while. And this is the threshold in which you need to register for VAT if you are trading. Now, there are certain exclusions, but once your business turns over 85,000 in sales, not profit, you would need to VAT register. So again, as inflation is rising, more and more small businesses are being caught out. So let's say you sell high volume or high value, could be low volume, high value goods, and the profit margin may actually be 10, 20%. It may be a very low income for income tax purposes, but you may very swiftly hit that VAT registration threshold. Be careful, because as incomes rise, as we said, everything else is increasing. This VAT threshold means that more people, more businesses are going to fall in line with the VAT threshold. So to bear in mind that means you as a client of somebody else may also start receiving more VAT invoices. So if you're not VAT registered, it's an extra cost to you. It's a burden. It's 20% extra real money. So just be really mindful of that. And the thing to be careful of is exceeding that threshold, because there are penalties if you get to a certain point and you've gone over that threshold and it's very late down the line. And this threshold is based on a rolling 12-month basis. So we could be looking at January to December. You go to the end of December, you go, right, have I gone over 85,000 in the last 12 months? No. Okay, well, I'll go to the next month, being the end of January, and so on. So it's not aligned with the tax year. So be mindful that you don't send your tax return into your accountant, gone over the threshold, and then you're filing in January, you're 9 months late in terms of your VAT registration. HMRC, aren't too forgiving when it comes to penalties. They want to raise revenue, although they're not monsters, I will say. They can be incredibly helpful. It's also worth noting that businesses can voluntarily register for VAT at any time, providing they're trading. So there may be a good reason for you to become VAT registered. Perhaps all your business, your business to business, all of your business clients, whoever you're providing to, are VAT registered, and you can reclaim your VAT. Or perhaps you need it to trade internationally. Perhaps you need a VAT number. Perhaps for commercial reasons, it suits what you're doing. But think very carefully about the time and the cost of filing quarterly VAT returns as to whether you voluntarily register, if it's really worth it. There's always going to be someone down the pub that told you, oh, you should VAT register and claim all your VAT back. But work that out first. Work out how much VAT that you'd be saving, because the burden and that quarterly return comes around really quickly. Point six, like this, gosh, this is so much to remember. Remember, the slides are coming to you later. This is a really horrid one, in my opinion. The corporation tax rate is rising from currently 19%. It's rising to 25% from April 2023. Again, another ouch here. What does that actually mean? So if you're a limited company and you've got profits in excess of 50 grand, they're going to be subject to marginal rates. Now, that marginal rate is actually 26.5%. I use the term marginal because it's not a defined rate. It's marginal because that's the rate of tax on a certain amount of the income when you do the effective calculation. So if you've earned 49,000 in profit in a company, 19% still applies. But if you earn £51,000 in profit, effectively 50,000 still at 19%. And then the next bit, the 1,000, is at 26.5%. So you might well ask, well, how's it 25? Well, this margin goes up to £250,000. I appreciate it doesn't say that on here, but it's the 250 where the cap is at 25. So if you earn 250,000 in profit exactly, you'd pay that rate 25% collectively. That's really important. You might think, well, why does that matter to me? Is to be if I'm a sole trader, or it may be putting you off a reason not to become a company, or maybe a company, maybe it's time to downsize. I'm going to share some thoughts about that in the next couple of slides. But finally, the other tax change that's really going to impact as well is that dividend tax rates have risen by 1.25%. And that actually came in from April 2022. There was lots of hoo-ha last year about something called the social care levy. They then scrapped it, another one of the U-turns. And what that means is, but what they didn't do, they reversed the NI, got rid of that 1.25% increase on NI, but they kept it on dividends. So that although this has come into effect this year, this is going to hit you this year when you're doing your tax return and you've got your dividend income. It's gone up by 1.25%. So not only that, it will have an impact, as I said, if you've got some shares in a portfolio, but also if you're an owner managed company, and that's how you're drawing your remuneration. So anyone who isn't a company, maybe a sole trader, it's very common practice for a company business owner, a small business, to withdraw their remuneration, their income, by way of a small salary, and the rest is dividends. So this is real money. It's going to affect people. I mentioned pensions earlier. I think that pensions have had a bad rap in the last 10 years and beyond. Is that people are mindful and frightened about putting in money into pension, but pensions could give you really good tax planning advantages. So certainly, for example, if you were a company and you earned that £51,000 and you didn't want to be paying tax at 26.5%, by putting £1,000 into your company pension scheme, you would be saving tax at 26.5%. So, and likewise, as an individual, you'd be saving at the rate of tax you're in by contributions. So get familiar with your pension. If you haven't, that's just an extra tip to just add in here. So the next big change, which is slightly different from the tax rate. So they're the core tax rates. Excuse me. In a couple of slides, I'm going to show you a screen that has all the current tax rates for 22, 23. So you can get a little bit familiar with what those rates actually look like and how these changes are going to impact. But just briefly, I want to touch on making tax digital. It's been in the press. It's here to stay. And the government are not changing it. It has been introduced a few years ago, and it was introduced for VAT returns. So anyone who is already VAT registered, you'll be used to filing your VAT returns via Making Tax Digital. Now, previously, this only applied to those who are VAT registered, earning over the 85,000 turnover. But now it applies to anyone that's VAT registered. So what does that actually mean? Is you need to use a compliance software. So we're talking QuickBooks, Xero, or you can actually use a spreadsheet with an API bridging sort of software to file your quarterly VAT returns. Now, there are some exceptions, but they're very slim, and I'm not really going to talk about those exceptions. So people are used to it if you're filing VAT returns. Now, this doesn't matter if you're a company or you're a sole trader. You're still going to have to do this for VAT. But the next step is it's being introduced for income tax purposes and for landlords as well. So those So when we talk about income tax, and for this purpose, we're talking about the self-employed, otherwise known as the sole trader, otherwise you freelance workers who are working and filing a self-assessment. We're talking about the same thing. That all means the same. So for income tax purposes, making tax digital is going to follow the same way it does for VAT. So in effect, we're going to be losing that self-assessment system and filing quarterly making tax digital returns, income tax returns, for those who are self-employed and landlord. Now, there is a threshold. It will be for those with income over 50K. Now, it was coming in April 2024, and you'd have seen a lot of press coverage. I had recently had a call with HMRC and asked someone on the helpline what they thought about MTD and the impact for them. And she responded very blankly that she didn't even know what I was talking about. So that's a bit of a worry when they were bringing in a scheme in from April 2024. It's no surprise that if the revenue don't know internally, how are us, the customers, as we're called now, not taxpayers, how are we supposed to know about it? So they have pushed it back, and there is a huge campaign. There has been for a while. As I said, it's here to stay. So the key thing that you can take from this is you're going to be required to file quarterly VAT returns if you're self-employed, but not for companies yet. But you will be if you're filing VAT returns. But for those self-employed in that income threshold, so what can you do now? I think, well, 2026 is a long way away. Where are we? We're 2023. It's only 3 years. That's going to come around really quickly when we think of tax years. So really, just my advice, if you're not using software yet, look into it. Use this time, the next tax year, to investigate, if you're not doing it already, what one works for you, what's the best software, what do you like the look of, you know, what dashboard is really working for you. As I said, there's some really key players out there: QuickBooks, Xero, Free Agent, Cashflow, FreshBooks. I mean, the list is endless. Just make sure they're MTD compliant, because if you started midway through the tax year, when you come to do your tax return, it's going to be a bit clunky if you've got half the year in a spreadsheet, half the year in a software. So think about how you might adopt it and then start rolling with it from a tax year, perhaps from next tax year. So now's as good as time to do that. So that's really what I wanted to talk about in Making Tax Digital, is that it is here, it is talked about a lot, but this great news about it being postponed to April 26, but remembering it's still going to come around quickly. So your business affairs need to be set up and structured so that you don't fall foul of the rules, you don't end up in penalties. So why does this matter? Why everything I'm talking about today, why does it matter? This is a big question now, is these tax rates. Should I be self-employed? Should I be a company? And there's so much to think about. And these are just some of the thoughts of the difference between, and the things we need to think about between the tax and national insurance, for example, the dividends versus income and what that means. So when you're self-employed, and we're talking partnerships as well, by the way. So we're talking self-employed, those unincorporated businesses versus incorporated businesses. But for simply, we've called it self-employed versus company. Unincorporated being a self-employed person or a partnership, which is two or more people who are self-employed. That would be unincorporated. Also, you'd include in there an LLP, which is what my firm is, as a limited liability partnership. You still registered and file under Companies House, but actually the self-employed tax transparency rules still apply. So as I said, self-employed being the partnerships as well as self-employed, and company being a limited company, limited by shares, so that somebody who's a director shareholder. So the things we need to think about now are the tax and national insurance. They're different. The different rates of tax as you're self-employed. You're going to see that one on my later screen. There's a difference between the taxation system. So what's going to work? What's going to be the best for you depending on your level of income? And I have to say, there's just no blanket answer to this. It depends on so many things. And one of them, the dividends versus income, one of the key things to think about is actually mortgages. So for example, if you're self-employed and you really need to show more profit for a mortgage purpose, you'd be showing the profit of the business. If you're a company and you're showing dividends, you'd be showing a lesser amount. So again, something to really think about when you're planning. And as I said, all of this is about giving you some information so you know what advice to ask for. As a sole trader, you can prepare your accounts on a cash basis, and money's received, rather than when invoices are raised. As a company, you're forced down using sort of accounting rules, and would be doing it on accruals basis. So when invoices are raised, accruing and prepaying, accounting terms as to when things relate to. So it's really nice and simple being self-employed, because you can use the cash basis up to 150. So for cash flow, it's something to really think about, because as we transition into the new tax year, you might have been already using cash basis, which case you're pushing it all down the line into the next tax year when rates are higher. Now's the time to review the way you are doing your accounting. Record keeping, there are ultimately, whether you run a business as a sole trader or incorporated, you still got to keep really good records. The beauty of being self-employed, you could simplify those records. You don't have to have a balance sheet, for example. But the record keeping is a key thing. Is as a company, you'd be required to keep more detailed records because of the way you're remunerating yourself and the way that the company accounting is done. Expenses, something to think about. So in a company, things like company cars become incredibly expensive, whereas compared to being self-employed, you could actually put more of your car through the business if you are running errands and doing lots of delivery work, for example. So that is something to think about. But also the VAT point is really crucial as well. The 85,000 applies to unincorporated or incorporated businesses. But the key thing that's really relevant here is if you are self-employed and you say, let's say you do a bit of design consultancy on the side and you earn 40 grand, you're under the VAT threshold. If you then set up, let's say, an eBay business where you make sales of 50 grand, you may think, well, I haven't gone over the VAT threshold. Well, you'd look at the two businesses together. You go, well, I've got 40 grand from my design work. I've got 50 grand of sales. I'm now at 90. I'm over the VAT threshold. So you would need to VAT register. And people also get caught out when they've got furnished holiday lets, because they are treated as a trade for VAT purposes. So what that means is you may need to register for VAT sooner, whereas the company is a separate legal entity. So these are just the things that may be on your radar to think about. And I'm just going to add into this, let me just move this slide on. Before talking about being self-employed, there's just 3 things you should think about between whether you should be a limited company and whether to be a sole trader. And I would call these the sort of core things to consider whether to be a company. The commerciality aspect. So you may be working with an organisation that requires you to be a company. Perhaps that's through IR35. Perhaps you want investors coming on board, investing into your business. So maybe there's commercial reasons why you'd want to do so. There's the tax and financial impact. We've talked about the tax differences, but there's the financial. I've mentioned about mortgages. There's also the possibility of how you can and can't make pension contributions. And then lastly, there's the corporate veil. So being a company ring fences your liabilities within the company. And that's a really crucial point, as that if, for example, you were financially exposed, you got sued for non-delivery of goods or something, you can ring fence those liabilities, whereas as a self-employed person, you're quite easily exposed. Very conscious of time. So I'm just going to move this through really quickly. It's so easy to register. So if you haven't started already and you're just scratching the surface of running a business, you need to use a CWF1 form to notify HMRC that you're self-employed. Right now, before MTD, it's a simple process, a self-assessment tax return each year, and that's it. Much less statutory requirements. As I said, we've talked about simplified records and those income tax rates for income taxpayers, 20, 40, 45% that we talked about. I won't touch on NIC, it's on the screen. You pay class 2 and class 4 when you're self-employed. So you might think, well, I'm paying income tax at 20%, and then I'm paying this 9.73%. It is actually this year. When you compare that to be a company, you've also got the dividend taxes. So I'm just going to very quickly run you through this. We've talked about that corporate veil, that ring fencing the liabilities, why minimizing that commercial risk allows you to keep the funds in the company, because your personal assets are affected when you're a sole trader. So that might be a commercial reason to have the corporate veil, to have a company. It may not always be about tax, but I've highlighted some of these points. So being a company, more statutory requirements, more filing with the company's house, and more HMRC obligations, more obligations as a director, more duties to sort of consider. So it's not a one size fits all, and you can see with these tax rates, it gets really quite complicated. As I've mentioned, all of this, and this is my favorite slide of all, it's my favorite quote, Albert Einstein: the hardest thing in the world to understand is income tax. And I've been doing what I do for 20 odd years, trying to to pull that down into 20 or so 30 minutes now is really difficult. So hopefully this has given you some snapshots, although I am concerned that my screen doesn't seem to show the slides I had for showing you the tax rates. But when you will get the pack, you will get that there, and it will show the current tax rates that you're looking at for dividends. So please keep an eye out for that. So quick question and answer. So is there any questions I've missed? I realise this is, let's just pull in and see if there's anything in there. I hope we're okay for time. Somebody's asked, are you going to share the presentation? Yes, EPA will be doing so. A question has come in for me. When will MTD apply to small limited companies who are not VAT registered? It's a really, really good question. We don't actually know. It's quite ambiguous. And I looked at the one of the tax bodies yesterday to see if I could get any clarity on when this is coming. Speculated 2028, not really, really clear right now. If we look back through COVID, there was a lot more support for the self-employed, a lot of angry people actually as a result of that. It feels very much like the government are pushing people to become sole traders when they're small businesses. Is that why they haven't done MTD? Are they thinking that you're going to be pushed into being a sole trader anyway? I don't know. It's not really clear. It may be because the way accounts are prepared under general accounting standards. So, are there any other questions that I may have missed? Hopefully that was useful information. Let's have a little look. I'm just seeing if there's any further question in terms of, well, one of the questions that was just asked actually was about business rate relief. And although I don't have a huge amount of knowledge on that actually, there are different reliefs for being a sole trader, for being a company, and also the size and the scale of the business. So do look into that. There is loads of detail. There has been changes and there has been some savings that government have offered to help people with the business rate relief. It's just not really my area of expertise to give you any real insight there. Somebody's asked about the erosion of the tax-free personal allowance when income goes over 100. Yeah, it's really harsh. It's been around for a while. And people are getting used to it, but they're still shocked by that because we're earning more because we need to earn more for standard of living and so on. But you could earn £101,000, and that £1,000 is then being taxed at 60%. So when I'm saying the top rate of tax is 45%, this year as well, the NI rate had increased a bit. So it was going up to 3%. It's 2.73, I think it works out. So the highest rate of tax that you could pay in the UK at the moment is 62.73%. I mean, that's huge when you think about it. So people always ask me the question, should I earn less? And ask yourself the question, is it better for you to retain almost 40% of that income, or would you rather earn less and have the work-life balance or whatever that gives you? Or might you compensate by putting some money into pensions to try and retain that 100,000? So just to reiterate, for every £2 over £100,000 of income, we're talking about individuals, not companies, you lose £1 of your tax-free personal allowance, which is that 12,570. And that's why we get to that 125,000 figure that we talked about. And then after that, it kicks into 45%. So imagine you're going, as an income taxpayer, you'll go 20% basic rate, 40% higher rate, 60%, ignoring NI, so that 2.73 was NI, 67, and then back to 45%. So it's really confusing and a lot to get your head around. Anything else? I think somebody else just asked the same question about when will it apply for MTD. Hopefully I've answered that question. I don't know when it's going to come in for small companies. And I think we just have to watch this space, and there's speculation about it, but I wouldn't want to comment really until it comes in. Anything else? Let's have a little look. I'm flipping back and forth to open and dismiss, and trying to review the screens as well. Do you know, a question, do you know if eBay integrates with Cashflow? I really don't know, actually. It's a really good question. I'm sure the tech team would be able to help you with that. Probably something to reach out quite specifically. And then what else have we got? I think I've covered most of this. Can you explain the trader's allowance for me? Just started. Yes, very quickly. I've got to wrap up. If you have just started trading and you're just sussing out and selling some light wares, for example, online, the first £1,000 of your profit is going to be tax-free. So I didn't mention that in the slides, but if you earn 999 quid, you don't pay tax on it, you don't register for self-assessment. If you earn 1,050, you would still register for self-assessment, but you can claim the £1,000 trading allowance. Yes, Paul, you can watch later. You'll be receiving these slides. I would just want to take the opportunity to thank eBay, thank Small Business Britain for having me. I appreciate them, Croaky. I've thrown so much information at you, and I'm talking really fast, so you can get as much information as possible. And I will make sure when you get the slides that you have that extra screen with the current tax rates applicable. Thank you very much.